So I want to walk you through a quick tutorial on how to identify which direction to place trades for options orders before an earnings release. You can see this is not a real account of mine. It's just like a dummy account since there's no purchasing power in it. But basically, before an earnings release, I will scout for options trades, like big block orders of options trades that are placed by large traders that are usually institutional traders, to identify which direction they're expecting the earnings release to drive the price, either gap up or gap down after or upon the earnings release. So first I'll type in an upcoming stock that they're about to report earnings for. So in this case today was Smile Direct, and I ended up buying put options or longing put options on Smile Direct, and you can see that Smile Direct is now actually going down a lot, and that was based on reviewing the options data just before the earnings release today. So I logged on at about 3:40, and then I started to look through the options trades of the day. I'll usually just look at the same day options trades, and if there's a real direction, then I'll place a trade on it. If I don't see a real direction one way or another, then I won't place a trade. Now, I use Thinkorswim. This is the best platform, I think, for identifying options trades, but I usually trade on Interactive Brokers or through JP Morgan Private Bank or whatever, other platforms. But this is a great platform for finding options time and sales data for that same day. So the way I go about it is I type in the ticker SDC, right? That's Smile Direct Club. And then I'll go look through all the options data. Now they have this trade analysis data. It's not that valuable because you can see that the price after hours is actually down. But it looks like if people are placing more calls above the market or ask, then they're expecting the price to go up. But that's not true. So there are two indicators to me that the price was going to go down upon earnings. Indicator one is if I look at the size of the option orders, I notice at the top, as the largest option orders of the day, they're mainly put options. And although there are a bunch of different call options in here, right, you can see that the call options that are long call options, so the way you tell if it's long is if the price at which they purchased is at or above the market price. So the market price here was 60. They paid 60 cents per put option, right? So that's the same thing here, right? So here they paid above market for the put option. So that was a key indicator to me that the price for the stock was going to go down after hours. You'll look for large trades that were placed that either between the bid and ask price, or even better, above the ask price, because that means the trader is, pretty certain that that's going to be the direction of the trade, of the price after hours. So here, this doesn't mean much to me because they could have been, so you can see here 265. This means that they were potentially selling put options because they were placing the order at the bid as opposed to the ask. So if you place it at the ask or above the ask, you're long, and if you place it at or below the bid, you're basically shorting it or selling it. So you can sell or buy calls or puts, right? So you want to look through the data and really understand, okay, but here's all these call options that someone placed, and I'll go here and I'll create a duplicate order just to see what the value of that order is. I see it's $66,000 if on that order. But let's look at this order, this put options order. Okay. $150,000. Then there's another put options order. How much is this worth? $450,000 or $452,000. So, even though there's this call options order here, this is just a hedge, right? It's 51,000. So that means they were probably shorting the stock at the end of the day and decided to buy call options that were, out of the money call options, because it's at $10. Obviously the price at close was $7.72. So it's well out of the money. So what that means is that they, in this case, they're just using it as a hedge. So what you really want to find directionally is, okay, put options, large order, put options, large order, put options, large order, another one. All of these were in between the bid and ask or above the ask price. So that means that they're longing the puts. These are huge orders, right? Relatively speaking. So these are the ones that I'll typically look at. I'll typically look at like the top 10 orders or so, right? And then I'll just parse through and look through other orders just to see if there's activity. Mainly what was a dead indicator for me, dead giveaway, at the end of the day, were all these orders that came in last minute, right? A lot of put orders came in last minute at the end of the day. They're selling calls here. They're selling calls here. Selling calls. So that means that they expect the calls to expire out of the money. And they'll collect the premium for selling the calls and writing those calls. So that's how I would find a stock that's going to go down. And then for a stock that's going to go up, let's look at Cisco. Now you can see Cisco is now trading at $43 a share. When it closed at the end of the day, it was at $41.95. So what I did was I went through here, okay? And I looked at all the orders, right? But here you might get confused and you might say, hey, well, there's these put options that were placed at 11 o'clock. Huge order. But in this case, they were probably just using it as a hedge. So what the dead giveaway is usually is the orders that come in at the end of the day that are large orders. Okay, so there's like 240, 200 calls, lots of calls. All these call options are coming in at the end of the day, right? That's dead giveaway number one. And then dead giveaway number two is I often look at the stock price. How is it moving in the last 30 minutes of the day? Are people buying a lot or are they selling a lot? Are there big jumps or swings in the price at the end of the day? Because that will indicate what bigger traders, institutionals believe the stock is going to, go in directionally. Then also, they're selling. Look at this. They sold 1,125 puts below the bid price. So that means they expect that the stock is not going to go down, right? It's going to go up. And they're expecting it might go up above $45 by June, right? Because you can see $3.03, that is the price that they bid. And the bid price at the time was $3.05. So it means they're selling the puts. Here, they bought calls at the same time. So this was clearly an order where they knew directionally where something was going to go because they placed this all at the same time. Here's another one. All the same person. You can see? So that's what I look for too. All the same person placing these orders right there and there. Because all of these were placed at the same time, right? They sold puts. They bought a large order of calls. They bought more calls. This person bought calls. And these people were just hedges. Okay? So you can see, sometimes I will refer to the trade analysis where it's so overweighted in one direction or another. You can see that a huge number of calls were placed above or at the ask price or between the market, right? So that's a pretty big deal because that means that directionally they believe the price is going to go up, not down. But you can see that a lot of people were selling calls too, but they were probably selling calls that were way out of the money, right? So you want to check and verify all of that. So I'll even reverse sort the price to look at, okay, whoa, there's a lot of puts there. So that would have been concerning to me. that they bought so many puts at such a high price, because if I were to place this order, that's like a $300 and something thousand order. So I like to balance it and kind of compare, like, you know, the biggest orders and see what the real big orders are. But I'll also take into account which way the stock price is moving towards the end of the day. I'll also look at the opening of the day too, to see, oh, is there a big jump in the beginning of the day or a big swing down at the beginning of the day? But you can see here at 500 calls, this is a lot of calls, right? That's a $400,000 order right there. So I'll just scout through here and skim through it. Look at this, how many calls are here? 45 calls, 1,000 calls. That's 500, that's almost 600 grand, right? And even more calls here. So they clearly knew that the price was going to go up. Otherwise, they wouldn't have bought all these calls. That would just be stupid, right? So those are the indicators that I look at. You really have to kind of get a feel for it. Sometimes it's not perfect, and if you don't have a good reading, then you don't want to get invested in it. You don't want to play the stock via options trades. But here you can see they're selling all these put options collectively at the same time towards the end of the day. So that was a clear indicator too. A lot of put options being sold because they thought that the stock was going to go up. Here, there's another 1,000 order for $50 calls expiring in January. So they really believe that the stock directionally is going to go up. So that's what I do to look for good direction on placing options orders. I don't know if that really helped understand it much, but it's really about just getting a feel. So when you first start trading options, you're going to want to be conservative. The mistake I made when I first started trading options is I would place orders for $20,000 or $25,000 at a time or more when I didn't know what I was doing. I didn't even know about this data that it exists. So if you're a newbie options trader, place like an options order for 2 options or something small, or 1 option, just to see directionally if your thesis around looking at the options trade data and the way it pans out is correct. But the one thing I would never do with options trading is make it up as you go along. You can't just look at the stock price and assume, oh, it's going up, well then it's going to go up, right? Because sometimes it'll go up at the end of the day and it'll go down. And if you looked at the options data would have shown you that it was overwhelmingly bearish. That the options traders were overwhelmingly bearish on the stock price post earnings. So you really want to look at both and take them both into account to try to paint a story around which way the post earnings price is going to go, up or down. So that's all.